and most of all SFO for having me. Hopefully everybody can see the screen clearly.
Yep, it looks great.
Looks good? Okay. Okay. Who are we? Well, we are DeCarly Trading. Sorry, had to adjust my screen. All right. We're DeCarly Trading. We're located in Las Vegas, Nevada. It's the best time of year in Las Vegas right about now. It's beautiful. The sun's shining, but it's not hot. So if you happen to need a vacation, this is the place to come. If you have any questions or if there's anything that we can do for you beyond the class, here's all my contact information. As Michelle mentioned, decarlytrading.com. You'll find a lot of free trader education. We've got videos, we have articles, all kinds of fun things. You can also find us on Twitter and Facebook. So check us out there. Don't be shy. During the trading day and during the trading week, we post events that we're having, such as a webinar like this, different market ideas, commentary, things like that. So we'd like to see you there. Obviously, we're a brokerage firm. That's how we make our living. But we also like to make sure that traders are fully educated before they get into the markets. There's really not a lot of room for error here, and lessons can be expensive. So the idea is we want to shorten the learning curve because we want our clients to be around forever, quote unquote. It's my job to tell you that there's a substantial risk of loss in trading futures, options, and Forex. There are no guarantees that we're going to make money. There's only guarantees that we're going to have fun, right? Well, no, it's not always fun, but it is fun at times. Never a dull moment, that's for sure. Suggested reading, obviously I'm going to have a shameless plug for my books here. Trader's First Book on Commodities and Commodity Options are, they're available through Traders Press. The newest book, Currency Trading in the Futures and Forex Markets, in the Forex and Futures Markets, is also available at Traders Press. It came out in February, and the idea of this book is not necessarily to tell you how to trade currencies, but where to trade them. What we're going to talk about today is actually covered in Currency Trading, the book, obviously in much more detail than what we're going to do today, but this will be a pretty good primer. We're going to talk about the U.S. dollar index, and believe it or not, a lot of people are just not familiar with the dollar index, probably because it's kind of like the oddball of the currency futures markets. It's not traded on the CME group, which most of the other currency trades on. It's on the ICE exchange, the Intercontinental Exchange. And it's really the only diversified currency product out there, other than ETF currency futures. But, well, actually, I'm not even sure there is a diversified ETF futures. I take that back. But it's similar to an ETF in that you're buying or selling a basket of products at the same time. There are a few examples of that in the Forex and the futures markets. For example, if you're buying the E-mini S&P, you're buying a basket of goods. We know that. That's obvious. Most people don't realize that in the Treasury markets, when you're buying or selling a Treasury futures contract, you're actually buying or selling a basket of deliverable securities. But there's really nothing quite like the dollar index. It's very unique because you're trading a basket of currencies. I'd also like to, I just thought about it, there is obviously, you've probably heard of the CRB index. Everybody wants to trade the CRB index, but unfortunately, it's not really a tradable product. It's more of a guide. It'll tell you what the overall commodity markets are doing, but it's not something that you're going to have very much fun trading. It's too thin, and the odds of you making money are very slim. So the bid-ask spreads are just hard to overcome. Well, according to the ICE exchange, the dollar index is the leading benchmark for the international value of the U.S. dollar, and it's the world's most widely recognized currency index. I would have to agree with them. Obviously, that's kind of a marketing ploy, but I think that they're actually right. Anytime that you hear somebody talking about the value of the dollar on business news stations or the dollar in general, the first thing that they do is referred to the dollar index as traded on ice. The dollar index futures represents the value of the greenback against a basket of currencies rather than a single currency. Basically, it's diversified speculation. There's a couple advantages to this. Not only can you outright speculate in currencies using the dollar index future, but it might be a good way to hedge the risk of a international stock and bond portfolio. For example, we've all been aware of the relationship between the euro and the stock market, or the dollar and the stock market. In other words, as the dollar index goes up, the stock market tends to go down. That's not always the case, and it's not an exact relationship, but there's definitely something there. In theory, somebody that wanted to hedge their currency risk and is holding a large stock portfolio might, they might consider buying a dollar index future to kind of offset some of the currency risk built into their stock portfolio. Also, last year when metals were on the move, gold and silver particularly, a lot of traders would come to me and they'd say, well, Carly, I think that the government is printing money, and I think the dollar is going to trash, and I'm bearish the dollar, so I want to buy gold and I want to buy silver. But for some reason it never dawns on them that if they're bearish the dollar, maybe they should just sell the dollar index instead of trying to go to a different asset that has all these other things going on with it. It's true that in general, gold and silver will somewhat trade inversely to the dollar, but it's definitely not a pure relationship, and there's a lot of other things going on there, such as emotion and things that none of us could ever quantify. And besides that, those are two of the most volatile markets in the futures world. In my opinion, I think traders are better off just speculating on the dollar. If that's what their opinion is based on, go to the source. Well, the dollar index is, like I mentioned, it's a basket of currencies, but let's kind of break it down real quick. About almost 60% of it is the euro. Obviously, before the euro, it would have been, there would have been several more currencies. I mean, we're talking the lira, all those other things that are built into the euro, but nowadays 60% euro, and then the second biggest component is the yen, and then the third biggest being the British pound, and so forth. This is my opinion, but this is kind of what I believe. I think that the dollar index is one of the most underrated products on the board. Why is that the case? I'm not sure. It's often overlooked because maybe it's different, or because it's an index, it's not a single asset, so that makes things a little more complicated. And let's face it, humans migrate to what's easy and comfortable, not necessarily what's best for them. The crazy thing about the dollar index is you might see it listed as 3 different symbols depending on which quote source you're using or which trading platform you're using. It might be the IDX, it might be the EDX, or it might just be the DX. And once you figure out the platform that you're using, what the actual code is, you want to make sure that whichever symbol you're using is routed to the electronic market. You don't want to be trying to place open outcry orders in the dollar index futures. It sounds like a nightmare. You're probably not going to be happy with your fill, and you're probably going to wait a long time to get your fill back. And I'm not even sure, to be honest, if they even have a pit anymore. In fact, maybe they don't. Maybe they stopped it. But anyway, the bottom line is make sure that you know the platform you're using and which symbol you should be using before you enter an order, because those can be expensive mistakes. Each full handle in the dollar index is worth $1,000. So if the market's trading at 78.5, today it's actually closer to like 80 or 80.5, but you get the point. If the market's trading at 78.5, the notional value of the contract is $78,500. So you're basically buying or selling $78,000 worth of the underlying currency. Each tick in the dollar index is worth $10. And this is something to point out too. One thing that I love about the dollar index, not only is it diversified and so it tends to be a little smoother moving than some of the individual currencies, but It has a low margin and it moves a little slower than some of the others. For instance, let's take the euro for example. The euro has a tick value of $12.50. Not much different than the $10 tick value the dollar has, granted, but the dollar index doesn't move nearly as fast. On a day that the dollar index is up or down, 30 to 50 points or 30 to 50 ticks, the euro might be twice that. When you're looking at a quote board, make sure that you understand what you're looking at. I just told you that the value of a tick is $10, but what I didn't tell you is that it trades in half ticks. So if you look at a quote board and you see 78,555, despite conventional logic or what you might have learned in math class, that's actually 78.55 and a half. So it's 78.55 half is what somebody would quote that as. At the time that I put this together, and I believe this is still the case, the margin on the dollar index was $1,320. See, very affordable to trade. One of the great things about trading the dollar index is if you're bullish the dollar in general or bearish the dollar in general, using the dollar index, you kind of eliminate some of the country risk. And what I mean by that is there's really two types of market risk or two types of currency risk. There's macro or market risk, which includes the big stuff, interest rate risk, economic risk, and then there's country risk, which is micro. And it could be natural disasters or it could be political central bank risk, things like that. Anybody that was trading the Japanese yen during the earthquake about, what was it, a little over a year ago, would tell you that sometimes the micro risk is really what comes back to haunt you. You can do all your research and all of the other things and all the fundamentals and be dead on, but an unexpected event that is strictly relevant to that specific country or that currency could really take you for a ride. If your goal is to mitigate the country risk and to gain exposure to the market risk or the macro, trade the dollar index outright. You buy or sell the USD versus major currencies. There's no need to construct a similar Forex holding plan through trading multiple pairs. I always say keep it simple, stupid. And the dollar index does that for you. I've talked to a lot of Forex traders that will attempt to do this on their own. What they do is, they'll go long the euro dollar, they'll sell the dollar yen, and they'll put all these things together and so that they have a basket of holdings, but they could have done the same thing with a single transaction of the dollar index. We probably all are familiar with the term hedging. Hedging is basically trading a position in a like or similar asset to reduce the risk of adverse move in another asset. What you might not realize is in Forex, when people talk about hedging, they're not necessarily talking about the hedging that you and I have come to know. They're talking about a strategy. In Forex, hedging is holding both a long and a short position in the same pair and usually in the same quantity at the same time. In other words, if they buy 100,000 units of the euro dollar, which is a standard contract in Forex, and they sell 100,000 units, in the world of futures, you'd simply be flat. You're out of the market. But in Forex, before the NFA stepped in, I should say, it used to be the case that traders could be long and short at the same time. Obviously, there's no financial benefit to the trader. The only person making money off of that is the broker because they're getting 2 commissions. Basically, hedging in Forex isn't hedging at all. It's completely eliminating the market risk on all hedged contracts. With the elimination of risk comes the elimination of profit potential, and like I mentioned, an extra commission. So it's good for the broker, not so good for the client, which is why the NFA banned this type of practice simply because it just makes no sense. The goal, what traders were thinking, or what their mindset was, if they're long and short at the same time and the market rallies, they can just take a profit on the side that they're making money on, hold on to the side they're losing, and hope that it comes back. But you know what? You could have had the exact same payout by being flat and then selling after the market rallied. Okay, I take it back. Not the exact same payout, because in the first scenario, you're going to pay 2 commissions. In the second scenario, you're going to pay 1. So it's the same payout, different transaction costs. That's why brokerage firms loved it. Now we're going to get back kind of on the subject anyway. Isolating country risk. You can isolate country risk by really taking the opposite position in the dollar index than is being held in a Forex pair. For example, if you go long 100,000 units of the euro dollar, the notional value is about, assuming that the euro is trading at 131. Obviously, that's not true today, but it's not too far off. Anyway, the notional value, if it was trading at 131, would be 163,750, so we'll call it about 164. You could sell a dollar index futures with a notional value of approximately 80,000, in which 45,000 of that is made up of the euro, because remember, it's almost 60% euro. What that leaves us with is basically a hedged position. This truly is a hedge. Unlike the Forex hedge, in which it eliminates risk, this mitigates risk. And what it also does is it basically focuses the trade on the micro and eliminates some of the noise. In this situation, if we took the numbers and netted them, the trader's long about 118,000 worth of euro. And again, it's a hedge. If you're making money on the euro dollar, I should say the Forex position, you're probably going to be losing on the dollar and vice versa, but that's okay. They're balancing each other out. They're giving you a peace of mind. And again, what it's specifically doing is mitigating the macro risk and focusing on the micro. So if you have some particular reason that you think the euro specifically is going to move in a direction against the dollar and not necessarily just the dollar in general, moving against other currencies, this is something that you might want to consider. And once again, you can visit traderspress.com. They have competitive pricing on all books, and Michelle did mention she might give attendees a little bit of a break there. Again, here's my contact information. If you have any questions or if I missed anything, or if for whatever reason we can't get to it on the question and answer period that we're about to get into, please send me an email, give me a call, see us on Facebook and Twitter.
All right, so yeah, go ahead and use that question panel if you have any questions for Carly, and I'll go ahead and take back the controls and talk about how to get those books. There we go. And first up, we have a couple webinars coming up. Next week, it's a full week of webinars from 9 in the morning to 5, and that's in Eastern time. So Central, that would be 8 a.m. to 4 p.m. And every day there will be a speaker every single hour from May 14th to the 18th. We're doing that in conjunction with Traders World. So there's a lot of different topics being discussed. You can go online and see everything that they have to offer. We also have Stephen Bigelow, and he will be presenting on May 22nd at 12:30, and that time is also a Central time. And both Stephen and Carly had articles in this month's SFO. You will be getting a link to that in your follow-up email, so you don't have to worry about writing any information down, but you can go to the articles and then click on the webinar. And then, for some reason, your books, I must have missed the first slide. So we'll go back to that one. There we go. So there's the 3 books: the Trader's First book on commodities, the commodity options, and currency trading in the Forex and futures market. Again, that link will be in your follow-up email. So you can write it down now if you want to jump right on and get a discount, but it will be in your email as well as a link to the webinar recording. So we have some questions flowing in. Carly, how do you feel about selling options on the DX? I noticed that 30 days out, you need to be pretty close to the fire to get any value.
Right. Anyone that's come to any of my classes in the past probably knows that we tend to be advocates of option selling, but unfortunately in the case of the dollar index, I just don't think it's the right market for option selling because, as you mentioned here, you can't get a lot of premium. You have to get a little too close to the fire, and on top of that, the options just quite frankly aren't as liquid as I'd like them to be, so the bid-ask spreads are wide, and it's kind of a thing where there's more risk than reward. It's, there's probably better markets to be selling options in.
All right. And trading dollar index. Go ahead. Sorry.
No, I'm sorry. It was my fault. I just thought of something though. With that said, though, one thing that the dollar index is great for, because the options are cheap, sometimes you can put together strategies like synthetics where, let's say, for example, if you're bullish the dollar index, you can buy a future and then you can buy a put to protect it. That way you don't have to worry about stop orders and getting stopped out. You just buy your put, you have insurance, you have limited risk, and you let it go and see what happens. So it does provide opportunities there because the options are cheap.
All right. And trading dollar index futures has more trading costs as compared to currency pairs?
It really just depends on the circumstances and your brokerage arrangement. I would venture to say probably not. A lot of people believe that Forex is cheap, probably because they did a good job at marketing the commission-free trading and things like that. But we all know that, at least nowadays we know that if you're trading commission-free, they're getting you somewhere else, right? It's usually in the form of the pip spread, and you're probably paying a heck of a lot more to execute in the Forex market than you are futures if you're with an arrangement in which you're paying a pip spread and no commission. If you're with an arrangement that you're trading through an ECN market and you're not paying a pip spread but you're paying a commission on top of it, it's possible that you might be paying maybe a little less because you don't have to worry about exchange fees. But I would say in general, as long as you have a fair brokerage arrangement and you did your research before you open the account, the transaction costs are going to be about the same.
All right. And which futures platform do you like the most and affordable?
Well, we're an IB of PFGs, and so we have access to multiple platforms, everything from the freebies up to the Cadillacs, and so each and every platform has its own advantages and disadvantages. The platform that I use is called Quick Screen Trading, and I love it. Is it cheap? Absolutely not. It's probably not. Cheap is not the word, but if you do a lot of trading and you don't have a day job, you're trading for a living or whatever the case is, it's probably worth it. If you do have a day job and you're trading on the side, I would say a couple platforms that I do like. Obviously, PFG's Best Direct Date is fabulous because it's free and it has free real-time streaming everything, and it has just about everything anyone would need in a platform for free. And another popular choice is NinjaTrader. A lot of traders like NinjaTrader. The only downside of NinjaTrader is it doesn't have options, but the charting and everything else is great.
All right, and that's all we have for questions, but I'm sure that there's a couple more out there. So I'm going to give you a chance, Carly, to kind of sum up your presentation and tell us what the most important thing is that they need to know before they take off.
Okay. Well, the point that I wanted to kind of get across is to open your mind to some products that maybe you might not hear them people talk about or write about, or if you're one that frequents some of the trading blogs and things like that, you probably don't run across the dollar index very often. But that doesn't mean that you shouldn't take a look at it, because it does serve a useful purpose, and especially for traders that are just starting out. For beginning traders, again, it has low margin, it's liquid, at least the futures are, and so it gives people a good opportunity to get in the markets with possibly a little less risk than they would if they were trying to trade the yen or the euro outright.
All right. Well, and no questions came in, so I think you must have explained it pretty well.
Okay, perfect.
So I thank everyone for coming, and thank you so much, Carly, for being here with us today.
Thanks a lot.
All right. And again, you'll get a follow-up email so that you can read her article in this edition of SFO, and you will be able to contact her with any information and questions that you have, and be sure to check out her books. So thanks for coming, everyone.